Hi, and happy Monday. Mike Molina here. I wanted to bring you some exciting news. You may have heard through the grapevine that there's some big changes coming to FHA and also conventional loans. I'm going to review them here super quick so that you can get to the meat and potatoes and see how it's going to help you with your clients qualify for more house. All right. So I'm just going to share my screen and get right into it with you. So first up, FHA has lowered the cost of their monthly mortgage insurance premium by 0.30%. That may not sound like a lot, but it's actually pretty huge. How does this affect your clients? Well, if you look here, you can see, for example, if your client qualified for a $300,000 house, now they qualify for around $315,000. 400, they qualify for around 420, and so on and so forth. Now, these are obviously examples painted with a broad brush. There's HOA fees, there's weird taxes and things like that. But generally speaking, you're looking at a significant increase in the purchase power of your clients that are already pre-approved. So this might help open up a few more options. Now, getting on to Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are right now all about affordable housing, and they're targeting low to median income demographics, first-time buyers. They're really on this mission to help the underserved demographics. And they made some changes to how interest rates are going to be coming out moving forward. Some of them not so great, most of them pretty good, but you're probably hearing a lot about the not so great ones. So let me get into it and run through it. And then if you have questions, please feel free to call me. So it used to be that they would take the lower, we take all the borrowers on a loan, we take their middle credit scores, and then of all those middle credit scores, we have to use the lowest. Now, the software program will actually average the score. So if you had a 760 and a 600, you add the two together, divide by 2, and this is the score that the system will use for credit analysis purposes. So that's a huge win, okay? Then next up, conventional, you can actually do conventional loans without a credit score. However, almost 99.999% of the time, the reason that they don't have a credit score has to be because they just don't have any credit history. It can't be that they've had nothing but terrible credit history and therefore have no scores. So if they've never had any credit history, but they pay their bills and they have non-traditional credit, utility bills, and they pay their rent with their checking account and things like that, the software program will actually go through, read their bank statements, and create a non-traditional credit report from that data. So that's also huge and is going to serve a very underserved segment of our community. So next up, they have what's called LLPAs. You don't know and you don't care what that term is, but these are additional price adjustments to rate adjustments to various things on a loan. Some of these make interest rates higher. Some of these make interest rates lower, and you'll see very quickly as I explain some of these, they're designed to make interest rates lower for certain demographics, people with not a whole lot of money, people with lower to median credit scores, things like that. So just to give you a few examples of the changes. So this will now give lower rates for people with smaller down payments and credit scores above 760 and below 680. And by smaller down payments, I mean, they're really targeting the 3% down buyer. So it actually, in many cases, will make more sense to have your buyers put down less than 5% or 10% because they'll get a much lower rate if they put down only 3%. I know it's Fannie Mae and Freddie Mac. What can you say? We'll have higher rates for people with scores between 680 and 759. So again, that's the major portion of people where they fall. And so their theory is we'll get this group of people that's very large to pay for these other groups of people that are very small. So I don't make the rules. I just report the information. So lower rates for people with 30% or more down payment on investment properties. That's actually more like on any property, but especially on investment properties, there's a big drop. So that's huge. Lower rates for people buying 2 to 4 units. Very interesting. Owner occupied or as an investment. It applies across the board. Rates for second homes / vacation homes stays the same. They were already terrible from last year when they made the changes. Rates for finances, for the most part, unaffected. And here's the catch. All these changes are for these rate additions and subtractions based off of various criteria. They're called LLPAs. So a borrower can be exempt from these if they meet 100% of the area median income or 120% of the area median income in high cost areas, and at least one borrower is a first time home buyer. They won't be subject to these new additions and subtractions. So just to give you an example, in Salt Lake, the area median income is $102,000, and in Contra Costa, it's $181,320, and in Solano County, it's $122,880. So there's a lot of room here for first-time buyers. They have to make an awful lot of money to be hit with these. So as you hear all the panic going on, just realize it's for a certain segment of people. And within that segment of people, a large portion of them are not going to be subject to these new costs. So that's pretty much it. If you have any questions at all, please don't hesitate to give me a call. I'm always happy to go through this in detail. And if you want these slides, let me know. I'm happy to send them to you. Thank you so much and have a wonderful day. Take care.